Hey, you guys. Thank you so much for being here with me today. Now, you guys know the agenda here at the New York City Real Estate Expo. I am talking about real estate industry and the African American thought leaders and diversity through real estate. And I'm quite sure you know you are my guest for today. But before we get into it, please tell me who you are and introduce yourselves to the audience.
Okay. Hello, Altavis. Thank you for having me today. My name is LaShawn Talley. I'm a senior business banker for the Tri-State Area Rep and Citibank. I work with professionals and business owners who have an owner-occupied need for real estate financing, term loans, business lines, and treasury solutions. Citibank is also an SBA preferred lender, and we are here to help you for your needs. Thank you.
Altavi, thank you for inviting us. My name is Dwight Makulski, and I'm the owner and managing director of the Premier Lending Solutions. And I am in the alternative lending space as a mortgage broker and somewhat of a hybrid role because I have to exit them out to traditional lenders as well.
Thanks so much for having me as well. My name is Tariq Bailey. I'm a branch manager with Mortgage Depot. We're an independent mortgage brokerage. Been in the business since 1992. I've been in the business since 2002 myself. And what we specialize in is residential and commercial, anywhere from co-op condos all the way to 1 to 4 families. And what we really focus on right now is similar to what Dwight does, is alternative ways of helping people who cannot fit in the regular retail bucket.
Thank you, guys. Now we're going to get right into it. Now, we all know a lot of people are still applying for mortgages, right? But please tell me what the process is when you want to come to you guys and ask the difference between purchasing or getting a business loan or a mortgage. What is that process is, especially coming from Citibank, Rashawn? Can you please elaborate for our viewers today?
Sure thing. So first off, we have a conversation with the individual to see exactly what their needs are. And after that, the individual will need to do a couple of things. They'll need to provide 3-year business tax returns, 3-year personal returns, also a quarterly interim, and that's a profit and loss income statement and a balance sheet for the business. Of course, the signed contract for the purchase property that they're looking to purchase, a personal financial statement, debt schedule, and 3 months bank statements. We'll review those financials to make sure that the financials support the request, and then we'll move off to then an application. And we'll meet with the client for a signed application, and at that time they'll also return a deposit for good faith, and that good faith is going to cover the environmental and appraisal fees for the report. It's a good time where we want to really see what the business does, get up underneath the hood, and also examine the property that the client is purchasing with our eyes.
Yes. So the process is a little different in the investment space. Where the investor, the stress test is on the property itself. So the investor needs to have an application, come with a signed contract, or if there's not a signed contract, a property that they're planning to buy, so we can provide them with a term sheet. And for the most part, once they get the contract, in order to move forward with the application, they need to provide have their deposit or proof of funds ready, and their deposit along with the general info for the property, which would be run. They would have run the property numbers to see if it meets the lending guidelines. So I'm not the direct lender, so I will work with the investor to find the best kind of lender to satisfy that investors' short and long-term goals in order to be funded and also capitalized after the deal.
What does Mortgage Depot do as far as that?
Sure. So we kind of do a little bit of both. Even though we're not direct lenders, we have to make sure that the person that is applying for a loan meets the criteria for the direct lender or the investor. So what we do a little bit different in that space is that they still have to provide the same necessary documentation, income, assets, etc. But most importantly, we do what you call AUS, automatic underwriting system, in-house. So in order for them to qualify for either a primary residence or investment resident, if it's through a wholesale lender that uses a Fannie Mae or Freddie Mac product, we run the AUS in-house to make sure they actually qualify before we take their loan application and submit it to the respective lender that we're going to do business with. So, along the lines of what these guys do, we do something similar. It's just that we have to make sure we kind of filter the loan, so to speak, before they, get to the actual lender that'll be doing the actual the lending and funding.
Very informative information, which segue into my next question. What's the difference rates between an investment property where one is coming in to purchase for residential versus investment property? Are the interest rates the same or are they different? Sean, can you please elaborate on that for us?
So the owner-occupied space versus the investment property, first off, the investment property, the rates are going to be slightly higher.
Okay, why is that?
Because of the risk. Whereas when you have an owner occupied, the owner's business is actually going into the space. So the risk of them possibly defaulting is very slim. Whereas when you have an investment property, you have someone else in the property, they could destroy the property. Also, the investor could actually walk away from the property. So that's where your risk lies in regards to that.
Yes, I agree with LaShawn that the investment property is a business in and of itself, but it's a place where the investor doesn't work in the actual space, and statistically, it's a higher risk, and therefore a slightly or much higher interest rate as a result to offset that risk, so to speak. And the other thing too, in investment in non-owner occupied properties, some of them can be, some of the loans are personally guaranteed, but some of them are non-recourse loan, which means they're not personally guaranteed. And that's another inherent risk in which has to be factored into the interest rate. So there are a number of things that lead to the non-owner occupied or the investment property being much higher, especially when the investor is more or less has lower experience or a shorter experience timeline.
Correct. So just piggybacking on what they said, rate equals risk, right? And so, as LaShawn said, someone who's an owner occupied that lives in the property, that's where they, rest their head at night. They want to live there. The bank knows that, and they're going to give them a better interest rate because the defaulting on that is not going to be, as high as to someone who doesn't live there. They're looking at it to make money, etc. So, at the end of the day, when it comes to interest rate, for the average person, rate equals risk. If there's more risk involved, higher rate. There's less risk involved, the lower the rate.
Now, getting back to my next question for you guys, how long does it typically take for a business loan or a mortgage loan to be approved for in today's market? What is the process? And we can start with you today.
So, as long as the client has all the necessary documents in place for the underwriter to make a decision, it typically should take anywhere between 24 to 48 hours for an initial, what we call a credit approval. Now, if it takes longer than that, it's because there's things that are missing, but it shouldn't take that much longer just for the initial credit approval. Now, an initial credit approval and a final approval are two different things, and sometimes people don't understand that, right? So once again, an initial credit approval is the underwriter reviewing all the preliminary documents, the credit, the income, the assets. To get a final approval, though, we still have to have the title report in, completed, reviewed, appraisal report in, completed, reviewed, to have what you call a clear to close. But initial credit approval shouldn't take no more than 2 to 3 business days. Typically.
Yes, in the alternative lending space or investment space, it depends because if it's a 1 to 4 unit versus a commercial, there are other layers in between. So in a 24 48 hour time, the initial approval can take place, and based on the lenders we work with, including private lenders, the overall process from start to closing could take maybe 2 weeks to 30 to 45 days, depending on the process. The biggest challenge that the lenders the biggest clog in the wheel is the appraisals. So if the appraisals come in very quickly and everyone is working and to provide the documents that they're required to provide, it can be much faster. But typically 30 to 45 days overall for the entire process. But it could be longer, especially in commercial, whereas when there's environmentals and other layers of due diligence that are necessary.
Good stuff to write down. Sean?
So just to piggyback, at Citi, most banks, they require full underwriting with a full package. And so a full package can take up to 30 days for a full approval through our writing division. Closing can take another 30 days. When we have the loans in underwriting, that's when we're ordering our appraisal and environmentals, so they kind of come simultaneously hand in hand for the most part. For the people who are interested in applying, what we do is after we review the financials, we will issue a letter of intent, and that can be issued within a couple of days. That is not an approval, though.
Okay.
The full approval comes after the application has gone through full credit, and that can take, like I said, 30 days.
So are you guys telling me it depends? The application can go between 7-14, maybe up to over a month. But does it all boils down to the application of whatever that person is putting down on that paperwork? Depends on if it's going to be a quick application process or something's going to take more time because they need to get more information in order to get that paperwork to be processed within a timely manner. So that is it based on the individual who's applying for that mortgage, you guys, or case on case scenario?
So first off, it's case on case, number one.
Okay.
When you're applying for a commercial mortgage, it's not an easy process. It can have its lengthy details. So for an example, an environmental report may require a phase 2. That may add additional time to it.
Okay.
If the client is in the space and they're refinancing, that might go a little smoother because they're already in the space.
Okay.
But when you're purchasing the space, I would always want to say, we say it could take up to 60 days to close, but you do have to expect a hiccup. Something could come up. The appraisal could come up short.
Right.
There could be an issue with the environmental. But that is the process. Once it goes through credit underwriting, then you have a closing period as well.
There are a number of reasons that can cause delays. So number one, the credit report when during the underwriting, when they're running the credit reports, there could be red flags that has to be explained or disqualified. Number two, the appraisal, as I mentioned, could be another thing. And number three, when the lenders are doing their due diligence on the property in terms of title and even insurance and the location, that has a big factor, especially when it comes to the non-owner occupied investment properties, because neighborhoods and zip codes differ, and it could be one street difference makes the difference in appraisal. It makes a difference in the lender's willingness to want to lend. So there's a number of factors that can cause the delay, and one of the biggest ones too is that the investor might not provide the documents on a timely basis, and or the underwriting might be backed up. So there's so many things, and it varies from case by case. It's daunting.
Hey guys, so there's a flip side to it. It can be daunting. There's absolutely no doubt about that. But from my experience with some of the lenders that I do work with, United Wholesale Mortgage is one of my top wholesale lenders. Their underwriting experience is actually a little bit different. So if the client is automatically approved through, say, Freddie Mac, for example, I don't know if we're doing it anymore, but when the market was up and coming, they used to do things called appraisal waivers. So an appraisal waiver is when the loan to value is adequate enough where the bank doesn't need to actually have a physical report. They'll do what you call a desktop review, and then that will be sufficient enough for them to use the collateral for the deal. And as long as the client can meet the guidelines that they need for the credit and the income, then I've literally closed loans with this bank like in 3 days. So it's possible to have a very, very fast closing with all those factors being in place. Now, typically, is that the case? No, the average person, as my peers has just mentioned, it's usually a 30-day process. But there are cases, if they have their paperwork together, they have their credit together, the appraisal's not an issue, the title's not an issue, we can close within reasonably 2 to 3 weeks.
Okay. Now to get right back to before we move on to our next question, LaShawn, can you tell us what environmental reporting is? You mentioned that earlier. What exactly is environmental reporting?
So the environmental report basically is an independent company that the bank will hire. Mm-hmm. And basically that company will go out and inspect the property. They will make sure that that property does not have any tanks or anything that's environmentally challenging to the property. Mm-hmm. So heaven calls that you happen to default on the property,
Yes.
the bank can still sell the property to recoup the funding for the mortgage. If there's a tank or if there's any type of environmental situation, then the bank is not able to sell the property or recoup funds. That's an issue. And so when we say in phase one is the inspection. They go out and look at the property, make sure that there's no issues. If there has been gas tanks buried down below, have they been removed? Have they been sealed? And if that is the case, if there's anything that has been done to the property, any type of oil, or if you're next to a gas station, there's been leakages, that's when an environmental phase 2 will come in. And that's an additional fee, again. And
It's
that's
always
going to, it's always money. It's always money. It's going to be a little bit more money because they may have to drill holes into the ground. They may have to drill holes into the ceiling. Not the ceiling, the floor, the concrete floor. They may have to drill holes into the wall. So it just depends on what's needed for the phase 2.
Okay.
So that's what an environmental is. And every single commercial mortgage is going to require an environmental when you are doing a request through a financial institution.
Sounds good, LaShawn. Now this is a loaded question for you guys. So you guys let me know how much you guys want to go into it. Here we go. How much can an individual borrow? And what is the maximum loan to value ratio for a typical mortgage nowadays? Is it too loaded, or just give me just a little tidbit?
This is not a loaded question. This is the real truth here.
Give me the real truth, LaShawn. Please share with us.
So when we talk about bank loans and conventional mortgages, the individual must put down 20%. We'll finance the 80%. Our loan size is a minimum of $250,000, and we go all the way up to $5 million. We also are an SBA lender. This here, the client puts down 10%, and we'll finance 90%. We can do a 7A or a 504, and if we do a 504, we do a partnership loan with one of our CDC partners. But once again, those loans go to $250,000 and they top at $5 million for SBA.
Yeah, in the investment space, alternative lending space, generally it's based on the proof of funds that you have, and most lenders will take about will fund about 80%, and the investor will fund the rest, the 20%. Depends on the level of investment investor you are. So if you have high experiences, then the lender will go up to 90% loan to value.
Now, don't forget to download my new ebook where I'll be providing the simplest steps of how to safeguard your critical documents through the loan signing after you close on your residential or investment property. Don't forget to download in the description bar below. Thank you so much for your support. Now back to this episode.
And if you have a lower experience, it might go down low as 70% loan to value. Again, to mitigate the cost, the risk, so to speak. In terms of the minimum, minimum of 100,000 for property, and it depends on the kind of lender in this space. It could be 10 million, 50 million, 100 million, some say no ceiling. But generally speaking, it's just simply based on the value of the property and the stress test of the financial viability of that property, and not necessarily on the individual's circumstances.
I think that was a loaded question for me because I'm a broker. So my channels are a little bit different. So we offer products like USDA, which is a loan based for people who live outside of your normal city limits. You're more in an agricultural rural area. That's 100% financing. Then we got VA loans, 100% financing, right? We do FHA, 96.5% financing with the 203K product, which adds more money. So it all depends on the specific client, per se. As far as everybody's different, and that's kind of the niche that I have as a broker is I don't look for, the one size fits all product. I look for the client and then try to find the product that fits them. But the main thing, just to everyone's point here, is about the loan amount. Some lenders do cap you. We would have to get an exception for anyone that's looking to borrow money under 100K. I think the bottom line is usually like 100K is where most lenders are comfortable. And as far as Max says, as my colleague here just said, There's lenders that'll be very aggressive up to the multi-millions. But once again, in order for someone to borrow that, they got to show that they have the ability to repay that, right? So we're not giving away free money, folks. They got to be able to show that they can borrow no free money. They got to be able to show that they can get, pay this money back.
Rate for 20 years. If you're doing SBA, the SBA will go to 25 years, and that's a fixed rate too as well. And you can change up these terms depending on what the borrower will need.
Yes, so the repayment terms is in the alternative lending space is a little bit interesting and different. So one kind of funding is the bridge funding, which is typically a 12-month temporary funding to renovate the property, and that is generally interest only for that 12 months, or if you need an extension. And then the investor would refinance into a longer term mortgage when the property has reached is fully renovated and has the highest value, the after repair value, which would be, we could channel that, it would be a kind of the conventional process. So it could be a 30-year mortgage, it could be a 5-year interest only or adjustable to allow for the cash flow to maintain. It could be any variation, combination of 15-year, 30-year, and so on. Or they could go to a traditional lender at that point, given the property meets the guidelines for a traditional lender. So it really varies a lot.
Same thing as these guys said. The traditional 30-year loan, 30 years. People can opt, if it's a refinance situation, into a 15-year loan. As a matter of fact, if it's a refinance, if they have 27 years and they want to go back to 27 years, they can do that. But the traditional mortgage is 30 years for the most part. And then you have your off products where you can do, like Dwayne was saying, a balloon payment after a certain time, etc. But plain and simple, 30 years for the most part.
Now, which leads me to my next question, guys. Now, can you guys, current companies, can you assist with an existing mortgage? The person comes to you that wants to refinance. Can you guys assist them with a current mortgage? They want to go back and refinance on that property. Can your companies help them with that?
The most important thing is making sure the equity is there. You cannot refinance with zero equity because a bank is not going to take 100% lien position on anything, right? So the most important thing is making sure that the loan to value exists. And as long as the loan to value is there, that's the starting point. They still have to qualify for credit and income. But when those two factors, or all three of those factors, are in play, then a refinance can definitely happen on a pre-existing loan.
Yes, I agree with Tariq. That's the case. In my case, it has to be non-owner occupied, and if someone non-owner occupied, and if someone an investor has that kind of property, it has to have enough equity, typically more equity than an owner occupied property, to offset the expenses that come with that, because every refinance comes with some level of expense, closing costs, that will have to be factored in to figure out if it's a good deal opportunity or not. So yes.
LaShawn?
And so yes, and we do refinance existing mortgages. We also refinance existing SBA mortgages.
Really?
A lot of the SBA mortgages are 504, 7A. They are in variable rates. Mm-hmm. And so you're finding those rates at 7 and 10%.
Yeah.
So it's a great opportunity now to refinance and lock into a fixed rate for SBA as well as conventional.
Now, speaking about the SBA loans, LaShawn, did this occur after the COVID situation when a lot of businesses were struggling, or you guys always had that program in place with assisting SBAs to go back to refinance?
So SBA has always been available. Mm-hmm. The 504 program sort of, I think, really took off during COVID because the rates were so low. Okay. And then also the 7A also took off. But now the interest rates are impacting those loans. And so clients are having to either refinance or hold them. The SBA has a 10-year hold, or it's a prepayment penalty. Mm-hmm. And the 7A has a 3-year hold, or there's a prepayment penalty. So a lot of the 7As are now starting to be refinanced because the rates are variable and people want to lock in at a fixed rate.
Good information, LaShawn. Now, here's the thing, guys. If anyone wanted to follow you all, LaShawn, I want you to start with yourself. Where can they follow you? You have any socials, or where can they follow you at Citibank to get in contact with you?
So I am on LinkedIn. You can check me there, LaShawn E. Talley. For Citibank, it is LaShawn.e.talley@citi.com for an email. My phone number, and you can also text me at 917-239-4139. And please, right now, don't forget to ask about our commercial mortgage promotion that is going on. The first year, the rate is 2.99.
Right now.
Amongst some other things. And that promotion will be going on until June, the end of June 30th of 2023.
So my company is Premier Lending Solutions, and we're based in Brooklyn. And you can find me on LinkedIn as well. Simply type in the word Dwight Makulsky. That's MCCAULSKY, last name, and you'll find that big smile. Also on the other social media, if you search Premier Lending Solutions, you'll find me there, or www.premierlendings with an S.com, or 917-764-4207.
You can find me on LinkedIn as well, and we have a brand new social media. It's Team Bailey _Mortgage Depot. So it's Team Bailey _Mortgage Depot. That's our Instagram account. And to reach me directly, you can contact me anytime at 845-705-5587. And that's Mortgage Depot branch manager Tariq Bailey.
Thank you guys so much for stopping by. I super appreciate it. And also, they'll be able to find all your information in YouTube, our YouTube channel, the Commercial Agency YouTube channel.